The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Welcome to the webinar, everyone, the Bucket Plan On Demand series. Today's topic is an asset allocation strategy your clients will actually understand. So we're going to be covering the actual philosophy of bucketing and why to time segment the money based on the purpose and the time horizon of when you're going to access the assets and what the purpose of the money is. So important for not only allocating people with existing assets, but also for goal setting for younger clients to fill those buckets and prioritize what buckets to fill and when.
So as we all know, bucket planning and just bucketing money, the concept, the strategies, it's been around for a long time. If you research bucketing money, some of the early history dates back to the 1980s with Harold Evensky, really pioneering a lot of the language and concepts around bucketing money. And, certainly as we kind of got through the information age, the dot-com bubble, all the way through the dot-com crash, I think it was probably a lot of individuals' first experiences of the benefits of having a bucketing philosophy, especially those who were retiring or just about to retire. Certainly taking a bucketing strategy probably created more efficiency within their overall retirement plan. And then into the mid-2000s, 2008, we certainly saw the Great Recession. And what was interesting is this whole concept of sequence of returns risk really came onto the scene. We saw in 2009 that the government suspended RMDs for the first time. And if you really think about that, required minimum distributions cause forced income. Forced income, when the market is down, creates sequence of returns risk. And so all these research reports came out talking about how to mitigate sequence of returns risk. And one of the top ways that you could mitigate sequence of returns risk is through a bucketing approach. And I think the beauty of the bucketing approach is this simplicity. Simplicity is the ultimate sophistication. There's so much sophistication in the types of retirement income plans, tying together taxes and investments and legacy planning and all these different components that we do on a day in and day out basis. But the magic is being able to simplify it for the consumer so they have the confidence and the peace of mind to buy into your recommendations. And the bucket plan is such an incredible tool to be able to simplify what we're able to do to help out our pre-retiree and retiree clients mitigate risks. And as Jason mentioned earlier, for the rest of our clients, help them actually have an asset allocation that they understand.
When I think about sequence of returns risk, and when you think about sequence of returns risk, what causes sequence of returns risks? So there's two different ways to look at this. One is, Dave, as you started to say, like forced income can cause sequence of returns risk. Requiring a steady paycheck can cause sequence of returns risk. And then ultimately, life gets in the way, right? A third component where you need to take unexpected or income or withdrawals from your assets when the market's down or your account balances are down. And that leads into the next thing is what causes sequence of returns risk? Well, it's kind of a perfect storm in your portfolio where if the market is down, obviously equities, and then you need to sell out of the portfolio, you can never make that money back. But what about the portion in bonds? Well, interest rate risk can also cause sequence of returns risk because as we all know, as interest rates rise, bond values go down. So people think that's the safe haven in their portfolio. They'll just go to the bonds and liquidate bonds. But ultimately, what can happen is if the bonds are down, that can cause sequence of returns risk too. So how do we mitigate sequence of returns risk? It's a simple three bucket approach: now, soon, and later, right? The now bucket everybody has. That's the money in the bank. That's the cash equivalent, right? But really it's that amount of money that you're going to be able to put your head on the pillow and sleep soundly at night. The soon bucket is that preservation bucket. It's kind of like that's the money, if you get that one set up right, that's what can mitigate sequence of returns risk, because typically it's where people go through the money in the bank or they're low on the money in the bank in the now bucket, and now they got to take income or withdrawals and out of their portfolio, and they never had a portion of it set up in a vehicle or in a way that they can confidently take income or withdrawals without causing sequence of returns risk.
I remember the first time I saw this sitting in your office, actually, and it was just such a light bulb that went off. I mean, I was so used to seeing charts and graphs and ledgers to try to illustrate asset allocation and how the whole plan came together. And to be able to see this visual on one page or on a dry erase board in one snapshot, that really painted the picture of the entire asset allocation, the now, soon, and the later. I just, immediately knew this was something that could benefit all of our clients to be able to have a plan like this in place.
Many years ago, Dave, this started out. And what I used to do is I used to write up on, like a dry erase board, an electronic version, but up on the top of it, I would write retirement income plan, because most of the people I was working with were people that were pre-retirees and retirees. And so I was talking to them about segmenting their money in retirement income plan. I've been doing that since the 90s. And I used to write across the top, write a retirement income plan, and then I'd draw three boxes. This is before now, soon, later, or any of the other stuff you see on the screen. But I used to draw three boxes, and then I would draw their different accounts inside of the boxes. And then we talked about moving those accounts around. And then I'll never forget when I drew, and I typically would draw the account balances at the top of the boxes. And then as I was talking to somebody, I drew circles around those account balances. And then the client said to me, well, that kind of looks like buckets. Mm-hmm. And it's like, oh, yeah, it's a bucket plan, and that was like the early evolution of it. And then just to continue to always try to simplify it, because I think that's the biggest thing that we do as advisors is we get too smart. I mean, we do. We get too smart. We get too sophisticated. And then ultimately we lose the simplicity. It's easy to do because you start overcomplicating things. Because the more you know, the more you want to teach them, the more you want to share. And sometimes you take it out of a format that's easy to keep it simple. And that's the beauty of this three bucket approach, is it keeps it simple for the client. You can use it for very sophisticated clients, and you can use it for very almost financially illiterate clients that don't really, they've saved money, they've done a good job, they've worked hard, they've built up money in the 401k, they have money in the bank, but they don't really understand the basics of financial planning. And so you can use this as a tool for the everyday hardworking family and also the more sophisticated investor, because they get it. And you can back up the dump truck of data to support the behavioral finance pieces of why bucketing is such a strong approach on how to really mitigate risk and sequence of returns risk and retirement and freak out risk like we've talked about.
So let's take them through each of the three buckets a little bit more in detail. Talk about some of this, the key components. Talk about the now bucket, Jason.
To gain access to the full webinar, click the link in the description down below.